Question 1. Topic: Alternative minimum tax. AMT. During a comprehensive review of a process that needs improvement, a taxpayer discovers that they are subject to the alternative minimum tax AMT. The taxpayer had significant long-term capital gains, exercised incentive stock options, ISO, and claimed high state and local tax deductions. Based on AMT rules, which of the following adjustments is most likely to increase the taxpayer's AMT liability? A. The long-term capital gains being taxed at higher AMT rate than regular tax rates. B. The inability to deduct state and local taxes under AMT calculations. C. The incentive stock option ISO exercise price being subject to an additional AMT adjustment. D. The AMT exemption phase-out applying based on total adjusted gross income. Answer: C. The incentive stock option ISO exercise price being subject to an additional AMT adjustment. Explanation: the alternative minimum tax AMT is designed to prevent high-income individuals from using deductions and credits to reduce their tax liability too much. Under AMT rules, state and local tax deductions, SOL, are completely disallowed. Option B is true but not the most impactful adjustment. Long-term capital gains are taxed at the same rates under both regular tax and AMT systems. Option is incorrect. Incentive stock options ISO trigger an AMT adjustment when exercised, as the difference between the fair market value and the exercise price is considered taxable for AMT purposes. C is correct. AMT exemption phase-outs apply, but are not an adjustment per se. If they only affect higher income taxpayers, option D is relevant but not the most direct cause of increased AMT liability. The rare regulations under IAS SSB 3 require ISO preference items to be included in AMT calculations, making it a significant factor in determining AMT liability. Question 2. Topic: International taxation. Foreign bank account reporting FBAR. While investigating inconsistencies across various units, an international consultant discovers that their US-based client has multiple foreign bank accounts with significant balances. The client is unsure about their reporting obligations under the Bank Secrecy Act. Which of the following statements best describes their FBAR obligations? A. The client must file an FBAR only if any single foreign account exceeds $10,000 at any point in the year. B. The client must file an FBAR if the aggregate balance of all foreign accounts exceeds $10,000 at any point in the year. C. The client does not need to file an FBAR if the accounts are dormant or inactive. D. The client is exempt from FBAR if their accounts are in country with U.S. tax treaty. Answer: B. The client must file an FBAR if the aggregate balance of all foreign accounts exceeds $10,000 at any point in the year. Explanation: under the Bank Secrecy Act, BSA and FinCEN Form 114 FBAR regulations, a U.S. person, including citizens, residents, corporations, and partnerships, must report foreign financial accounts if the aggregate value of all foreign accounts exceeds $10,000 at any time during the year. Option is incorrect because the threshold applies to the total sum of all accounts, not just a single account. Option B is correct because FinCEN and ERA regulations require reporting when the combined value of all foreign financial accounts surpasses $10,000 at any moment during the tax year. Option C is incorrect because even inactive or dormant accounts must be reported. Option D is incorrect because tax treaties do not exempt U.S. taxpayers from FBAR obligations. Failure to file FBAR can result in substantial civil and criminal penalties as per 31 U.S.C. SS and 31 C.F. SS.350. Question 3. Topic: estate and gift taxation. Step up in basis during a major transformation where existing methods of estate planning are being reevaluated. A client seeks advice on the tax implications of inheriting stock from a deceased relative. The stock had significantly appreciated in value over the years. What is the correct tax treatment of this inherited asset under U.S. estate tax law? A. The beneficiary inherits the stock at its original purchase price carryover basis and must pay capital gains tax on the full appreciation when sold. B. The beneficiary receives a step up in basis to the stock's fair market value at the decedent's date of death. C. The beneficiary owes estate tax on the total value of the inherited stock but no capital gains tax upon sale. D. The beneficiary must pay capital gains tax on the dip between the original purchase price and the value at sale regardless of inheritance rules. Answer: B. The beneficiary receives a step up in basis to the stock's fair market value at the decedent's date of death. Explanation: under IAS SS, when taxpayer inherits assets, they generally receive step up in basis to the fair market value (FMV) at the date of death. This means that Option is incorrect because the carryover basis applies to gifted assets, not inherited ones. Option B is correct because the RSSA provides that inherited assets receive basis equal to their fair market value at the decedent's date of death, reducing future capital gains liability. Option C is incorrect because estate tax is imposed on the decedent's estate, if applicable, not on the individual beneficiary. Option D is incorrect because capital gains tax is calculated based on the stepped-up basis, not the original purchase price. This rule provides significant tax savings for beneficiaries by minimizing capital gains tax when they sell inherited assets. Question 4. While investigating a complicated issue between different tax jurisdictions, a multinational corporation (MNC) finds that its subsidiaries in foreign countries are subject to double taxation on the same income. The company is structured in a way that its profits are earned in multiple nations, leading to a potential conflict between the U.S. tax system and foreign tax authorities. The company wants to ensure that it does not pay tax twice on the same income, but is also concerned about compliance with international tax laws. Given this situation, which of the following methods would best resolve the issue of double taxation? A. Utilizing the Foreign Earned Income Exclusion (RSS) to exclude foreign income from U.S. taxation. B. Claiming the foreign tax credit (FTC) under RSS to offset U.S. taxes by the amount of taxes paid to foreign governments. C. Structuring its foreign operations as pass-through entities to avoid direct corporate taxation at the U.S. level. D. Applying for an ERS private letter ruling to exempt the company from foreign taxation under international tax treaties. Answer: B. Claiming the foreign tax credit (FTC) under RSS to offset U.S. taxes by the amount of taxes paid to foreign governments. Explanation: the foreign tax credit (FTC) under RSS is specifically designed to prevent double taxation by allowing U.S. taxpayers, including corporations, to offset their U.S. tax liability by the amount of taxes paid to foreign governments. This mechanism ensures that income earned abroad is not taxed twice, once in the foreign jurisdiction and again in the U.S. The option Foreign Earned Income Exclusion (ESSS) applies only to individual taxpayers, not corporations. This exclusion allows U.S. citizens and residents working abroad to exclude portion of their foreign earnings from U.S. tax, but it is irrelevant for an MNC. Option C, pass-through entities for foreign operations, is incorrect because foreign subsidiaries of U.S. corporations are typically taxed under U.S. anti-deferral rules like Subpart F and the Global Intangible Low-Taxed Income (GILTI) provisions. Restructuring as pass-through entities does not directly eliminate double taxation. Option E, ERS private letter ruling for international treaties, is incorrect because ERS private letter rulings (PRS) do not have the authority to override tax treaties. Treaties themselves help mitigate double taxation, but PLR would not grant an exemption from foreign taxation. Question 5. During a comprehensive review of a process that needs improvement, a taxpayer realizes that they failed to properly account for the depreciation of a major asset in prior years. The taxpayer wants to correct the mistake and claim the allowable depreciation deduction, but they are concerned about potential penalty and IRS scrutiny. Given the rules for correcting depreciation errors, which of the following is the best course of action? A. File an amended tax return for the previous years to retroactively adjust the depreciation. B. File Form 3115 application for change in accounting method to request an automatic change in depreciation method. C. Recalculate the depreciation in the current year and claim the full deduction immediately. D. Request an ER re-audit to formally determine the correct depreciation adjustment. Answer: B. File Form 3115 application for change in accounting method to request an automatic change in depreciation method. Explanation ends. Under RERS procedures, taxpayers must file Form 3115 to request an automatic change in accounting method when correcting depreciation errors that involve improper accounting methods, e.g., incorrect depreciation schedules, omitted depreciation, or incorrect useful life. This allows them to make an adjustment under EISSA to account for prior year miscalculations without filing amended returns. Option amended tax return for previous years is incorrect because amended returns cannot be used to correct depreciation errors that constitute change in accounting method (EVRN Proc. 201513). Option C, recalculate and claim the full deduction immediately, is incorrect because depreciation must be spread over the asset's useful life and correcting past errors require ERA approval or procedural compliance. Option D, request an ERS audit, is incorrect because audits can be time-consuming and there is no guarantee that an audit would allow for the correction without penalties. Form 3115 provides more structured approach. Question 6. In a multi-location scenario where consistency requirements affect tax compliance, a retail business operates stores in multiple states, each with different state tax laws regarding sales tax, payroll tax, and income tax nexus. The business is trying to standardize its tax reporting processes to ensure compliance with all jurisdictions. Which of the following factors is most critical in determining whether the business has an income tax nexus in a specific state? A. The volume of online sales to customers in the state regardless of a physical presence. B. The presence of employees or business operations within the state. C. Whether the business voluntarily registers to collect and remit sales tax. D. The number of advertisements placed in a state regardless of customer base. Answer B. The presence of employees or business operations within the state. Explanation. Income tax nexus is typically determined by a business's physical presence, economic activity, or employees working within the state. Under Wayfair v. South Dakota 2018 and state-specific laws, states may impose tax obligations even without a physical presence if economic activity surpasses a threshold. Option volume of online sales is incorrect because while sales tax nexus can be triggered by online sales, economic nexus, income tax nexus generally requires a physical or economic connection beyond just sales volume. Option C, voluntarily registering for sales tax collection, is incorrect because collecting sales tax does not automatically establish an income tax filing requirement. Option D, advertising in a state does not create income tax nexus unless it results in significant business activity within the state. Question 7. As part of an ongoing evaluation of financial performance, a company is analyzing its inventory valuation methods. The company operates in an industry with fluctuating material costs and wants to select an inventory method that minimizes tax liability while maintaining compliance with IRS regulations. Given these objectives, which of the following inventory valuation methods is most advantageous for the company during periods of rising prices? A. First in, first out FIFO. B. Last in, first out LIFO. C. Weighted average cost. D. Specific identification. Answer B. Last in, first out LIFO. Explanation. The LIFO last in, first out method is beneficial during periods of rising prices because it assigns the most recent, higher cost inventory purchases to cost of goods sold, COGS, reducing taxable income and therefore tax liability. Option was FIFO. First in, first out assigns the oldest, lower cost inventory to COGS, increasing taxable income during inflationary periods. This method may result in higher reported profits, but also increases tax liability. Option C, weighted average cost, calculates inventory value based on the average cost of all goods available for sale. While it smooths out price fluctuations, it does not provide the same tax benefits as LIFO in rising cost environments. Option D, specific identification, tracks individual inventory items, which is most useful for unique, high-value goods. C. G, real estate, automobiles, fine, rather than for industries dealing with frequent price changes. Question 8. When addressing a dispute related to deductions, a self-employed individual is concerned about proving the legitimacy of business expenses to the IRS. The taxpayer regularly incurs travel, meals, and entertainment costs but lacks detailed receipts for some transactions. Given this scenario, which of the following records would be most effective in substantiating deductible business expenses? A general estimate of monthly expenses provided by the taxpayer. B. A written log detailing the purpose, date, and amount of each expense, even if some receipts are missing. C. Bank and credit card statements showing business-related transactions. D. Only the physical receipts for transactions over $75. Answer B. A written log detailing the purpose, date, and amount of each expense, even if some receipts are missing. Explanation. The IRS requires adequate records to substantiate business expenses, particularly for travel, meals, and entertainment under ERSSS. Detailed written log provides necessary documentation, especially when receipts are missing. Option general estimate is insufficient because the IRA requires specific details rather than broad estimates. Option C, bank and credit card statements provide partial evidence, but they do not prove the business purpose of expenses, which is essential for deductibility. Option D, receipts for transactions over $75, is incorrect because certain expenses require both receipt and log regardless of the amount. Question 9. While investigating a complicated issue between tax authorities, a corporation discovers discrepancies in how it has been calculating taxable income across different states. The company operates in multiple jurisdictions, each with varying apportionment rules. To ensure compliance, which of the following factors is most commonly used in state income tax apportionment formulas? A. The company's net income before deductions. B. The number of employees working in the state. C. The proportion of sales, property, and payroll within the state. D. The amount of federal tax credits claimed by the company. Answer: C. The proportion of sales, property, and payroll within the state. Explanation: most states use a three-factor apportionment formula based on sales, property, and payroll to determine how much of a company's income is taxable in that state. Some states use single-factor sales apportionment to encourage businesses to establish physical operations in their jurisdictions. Option net income before deductions is incorrect because apportionment applies to allocating taxable income, not determining total net income. Option B, number of employees, is relevant but is typically incorporated into payroll factors rather than being standalone determinant. Option D, federal tax credits, do not affect state income apportionment directly. Question 10. During a comprehensive review of a process that needs improvement, a manufacturing company realizes that its method of capitalizing and depreciating machinery may not align with IRS guidelines. To ensure compliance, which of the following factors is most critical in determining the proper depreciation method? A. The purchase price of the machinery. B. The useful life and recovery period defined under the MACA system. C. Whether the asset is financed through a loan or purchased outright. D. The taxpayer's preferred method of depreciation. Answer: B. The useful life and recovery period defined under the MACA system. Explanation: the Modified Accelerated Cost Recovery System (MACA) is the IRS-mandated depreciation system for most tangible assets, determining their useful life and allowable depreciation deductions. Option as or purchase price affects depreciation but is not the primary factor in choosing the depreciation method. Option C, financing method, does not influence depreciation calculations. Option D, taxpayer's preference, does not override ARA depreciation rules. Question 11. In a large organization where multiple departments need to coordinate tax compliance efforts, the accounting team discovers that certain deductions claimed by the finance department may not align with IRA regulations. The deductions pertain to executive compensation packages, including stock options and deferred compensation plans. The company is structured as a C corporation. Given this scenario, which of the following statements is accurate regarding the tax treatment of executive compensation? A. Stock options are always deductible by the corporation in the year they are granted. B. Deferred compensation must meet the requirements of IRS SSA to be deductible in the year it is accrued. C. Executive compensation exceeding $1 million per covered employee is always deductible as long as it is reasonable. D. The company can automatically deduct any amount of performance-based compensation if it is approved by the board of directors. Answer: B. Deferred compensation must meet the requirements of IRS SSA to be deductible in the year it is accrued. Explanation: IRS SSA imposes strict rules on deferred compensation plans, requiring compliance with specific deferral elections and distribution restrictions. If plan does not comply, the income is included in the executive's taxable income immediately, subject to penalties. Option is incorrect because stock options are only deductible when exercised, not when granted. Option C is incorrect due to IRS SSM, which limits the corporate deduction for executive compensation above $1 million unless specific exceptions apply. Option D is incorrect because performance-based compensation must meet strict criteria under IRS SSM, and board approval alone does not guarantee deductibility. Question 12. During a critical transition period where existing processes are being evaluated, a multinational corporation reassesses its transfer pricing policies to ensure compliance with IRA regulations. The company operates subsidiaries in multiple countries, engaging in significant intercompany transactions. Under U.S. tax law, which of the following best describes the IRA's approach to transfer pricing? A. The IRS allows any pricing method as long as it is consistently applied across all transactions. B. Transfer pricing must comply with the arm's length principle under IRS CUS. Corporations are not required to file any additional documentation if their transfer pricing is reasonable. D. The IRS permits companies to choose any method they prefer without IRS scrutiny. Answer: B. Transfer pricing must comply with the arm's length principle under ERCS. Explanation: ERCS requires that transactions between related entities reflect an arm's length price, meaning the price must be consistent with what unrelated parties would pay in similar situation. Option is incorrect because pricing methods must adhere to Treasury regulations and OAT guidelines, not just internal consistency. Option C is incorrect because large corporations must prepare and maintain detailed transfer pricing documentation, e.g., Form 5471, Form 5472, to support their methodology. Option D is incorrect because the IRA has authority to adjust transfer prices and impose penalties for non-compliance. Question 13. When dealing with a complex system that shows occasional discrepancies in tax reporting, a real estate investor finds inconsistencies in depreciation deductions for multiple properties. The investor wants to maximize tax benefits while complying with IRA rules. Which of the following approaches is most appropriate under MACRA's modified accelerated cost recovery system? A. The investor can freely switch between MACRA's and straight-line depreciation annually to optimize deductions. B. MACRA's allows for accelerated depreciation, but residential rental property must use a 27.5-year recovery period. C. Commercial real estate must be depreciated over 15 years under MACRA's. D. Depreciation recapture rules under ERCS do not apply when selling rental property. Answer: B. MACRA's allows for accelerated depreciation, but residential rental property must use a 27.5-year recovery period. Explanation: under MACRA's, residential rental property must be depreciated over 27.5 years, while commercial property follows a 39-year recovery period. Option is incorrect because depreciation methods cannot be freely switched each year once a method is chosen. Option C is incorrect because commercial property is not depreciated over 15 years, but rather 39 years under MACRA's. Option D is incorrect because ERCS requires depreciation recapture upon the sale of depreciable real estate, taxing portion of gains as ordinary income. Question 14. In a high-stakes environment where multiple challenges arise, a business owner operating as an S corporation is considering changes to ownership structure to minimize tax liabilities. Which of the following statements best describes the tax implications of an S corporation election? A. An S corporation is subject to double taxation like a C corporation. B. Shareholders of an S corporation must include their share of income on their personal tax returns, even if no distributions are made. C. S corporations can have an unlimited number of shareholders, including foreign investors. D. An S corporation can issue multiple classes of stock with different voting rights. Answer: B. Shareholders of an S corporation must include their share of income on their personal tax returns, even if no distributions are made. Explanation: S corporations are pass-through entities, meaning income, deductions, and credits flow directly to shareholders and are taxed on their individual returns, regardless of distributions. Option is incorrect because S corporations avoid double taxation, unlike C corporations. Option C is incorrect because S corporations are limited to 100 shareholders, and foreign investors are not allowed, must be U.S. persons. Option D is incorrect because S corporations can only have one class of stock, although they may have voting and non-voting shares. Question 15. During a major transformation where existing methods of tax collection are being scrutinized, lawmakers propose modifications to the alternative minimum tax AMT system to address concerns about fairness. Which of the following is a key feature of the AMT? A. The AMT applies to all taxpayers regardless of income. B. AMT is calculated separately from regular tax liability using different rules for deductions and exemptions. C. The AMT allows for unlimited state and local tax SOL deductions. D. Taxpayers must always pay AMT even if their regular tax liability is higher. Answer: B. AMT is calculated separately from regular tax liability using different rules for deductions and exemptions. Explanation: the AMT is a parallel tax system that ensures high-income taxpayers pay a minimum level of tax by disallowing certain deductions and exemptions available under the regular tax system. Option is incorrect because AMT primarily affects higher income taxpayers who claim large deductions. Option C is incorrect because state and local tax deductions sold are disallowed under AMT. Option D is incorrect because taxpayers only pay AMT if it exceeds their regular tax liability. Question 16. In a scenario where efficiency decreases across multiple tax jurisdictions, a multinational corporation faces challenges in determining the correct foreign tax credits to claim. Under U.S. tax law, which of the following best describes the foreign tax credit (FTC) system? A. The foreign tax credit allows corporations to offset U.S. tax liability dollar for dollar with all foreign taxes paid. B. Only income taxes paid to foreign governments qualify for the foreign tax credit. C. The foreign tax credit applies to both income and value-added taxes (VAT) paid to foreign countries. D. The foreign tax credit is unlimited and can be carried forward indefinitely. Answer: B. Only income taxes paid to foreign governments qualify for the foreign tax credit. Explanation: the foreign tax credit (FTC) under ISSS allows U.S. taxpayers to claim credit for income taxes paid to foreign governments to prevent double taxation. Option is incorrect because the FTC is subject to limitations based on U.S. tax liability on foreign source income. Option C is incorrect because VAT and other indirect taxes are not eligible for the FTC. Only income taxes qualify. Option D is incorrect because FTCS can be carried forward for 10 years and carried back for 1 year, but not indefinitely. Question 17. While analyzing the root causes of sequential problems in tax compliance, a publicly traded company identifies errors in reporting stock-based compensation. Under ISSS and applicable regulations, how should stock options be treated for tax purposes? A. Stock options are taxable to employees when granted. B. Incentive stock options (ISOs) generate ordinary income upon exercise. C. Non-qualified stock options (NSOS) are taxed at exercise based on the spread between the exercise price and fair market value. D. ISOs and NSOS are treated identically for tax purposes. Answer: C. Non-qualified stock options (NSOS) are taxed at exercise based on the spread between the exercise price and fair market value. Explanation: NSOS create taxable compensation income upon exercise equal to the difference between the exercise price and fair market value (FMV) of the stock on that date. Option is incorrect because stock options are generally not taxable at grant unless they have a readily ascertainable fair market value. Option B is incorrect because ISOs do not generate ordinary income at exercise but may trigger alternative minimum tax (AM). Option D is incorrect because ISOs and NSOS have different tax treatments. ISOs provide preferential capital gains treatment if certain holding requirements are. Question 18. During an emergency response where multiple areas are impacted, a state government considers tax relief programs for individuals affected by natural disasters. Which of the following is a key feature of the IRA disaster relief provisions? A. The IRA automatically suspends all tax liabilities for affected taxpayers. B. Affected taxpayers may qualify for extended filing and payment deadlines. C. Disaster-related casualty losses are only deductible if itemized deductions exceed 10% of OGI. D. Taxpayers must wait until the next tax year to claim disaster-related losses. Answer: B. Affected taxpayers may qualify for extended filing and payment deadlines. Explanation: the IRS provides disaster relief by extending filing and payment deadlines for individuals and businesses in federally declared disaster areas. Option is incorrect because tax liabilities are not automatically suspended. Only payment and filing deadlines may be extended. Option C is incorrect because for federally declared disasters, the 10% OGI threshold does not apply for casualty losses. Option D is incorrect because taxpayers can elect to claim losses in the prior tax year to receive faster refunds. Question 19. In a situation where formal requirements conflict with practical business operations, a small business owner considers whether to elect Subchapter S status for their corporation. What is one key consequence of making an S corporation election? A. The S corporation pays corporate income tax at the federal level. B. S corporation shareholders must report business income on their personal tax returns. C. S corporations can have an unlimited number of shareholders. D. The IRS automatically grants S corporation status to eligible corporations. Answer: B. S corporation shareholders must report business income on their personal tax returns. Explanation: S corporations are pass-through entities, meaning income and losses flow directly to shareholders who report them on their personal tax returns. Option is incorrect because S corporations do not pay corporate income tax at the federal level. Option C is incorrect because S corporations are limited to 100 shareholders. Option D is incorrect because corporations must affirmatively elect S-corporation status by filing Form 2553. Question 20. While investigating a complicated issue between different jurisdictions, a multinational company faces potential double taxation on the same income. Which mechanism under U.S. tax law helps prevent double taxation of international income? A. The foreign earned income exclusion under ERSS. B. The foreign tax credit under ERSS. C. The unlimited deduction of foreign income taxes. D. The ability to allocate all foreign income as U.S. sourced. Answer: B. The foreign tax credit under ERSS. Explanation: the foreign tax credit (FTC) allows taxpayers to offset U.S. taxes on foreign source income by the amount of income tax paid to foreign country, preventing double taxation. Option is incorrect because the foreign earned income exclusion (FEI) only applies to individuals, not corporations. Option C is incorrect because foreign tax payments are not fully deductible. Instead, they are credited against U.S. tax liability. Option D is incorrect because foreign income cannot be reclassified as U.S. sourced arbitrarily. Question 21. During a seamless transition where continuity must be ensured, a business restructuring plan raises concerns about the tax consequences of asset transfers. Under ERSS, what is key requirement for tax-free incorporation? A. The transferor must receive only stock in exchange for property. B. The transferor can receive cash and stock without triggering taxation. C. The transferor must retain 50% ownership in the new corporation. D. Any property transfer automatically qualifies for tax deferral. Answer A. The transferor must receive only stock in exchange for property. Explanation: under ERSS, property transfer to corporation is tax-free if the transferor receives only stock and maintains at least 80% control. Option B is incorrect because receiving cash boot triggers capital gain recognition. Option C is incorrect because the control requirement is 80%, not 50%. Option D is incorrect because not all transfers qualify. Only those meeting specific conditions under ERSS. Question 22. In a multi-location scenario where consistency requirements must be met, a corporation with operations in multiple states faces challenges in complying with state income tax apportionment rules. How does the Uniform Division of Income for Tax Purposes Act (UDIPA) help determine state tax liabilities? A. It requires businesses to apportion income using a single-factor formula based on sales. B. It provides a standard three-factor formula based on sales, property, and payroll. C. It mandates that corporations pay income tax only in the state where they are headquartered. D. It allows states to impose an unlimited tax on out-of-state businesses. Answer: B. It provides a standard three-factor formula based on sales, property, and payroll. Explanation: UDIP establishes a three-factor formula, sales, property, payroll, to apportion taxable income among states where a business operates. Option is incorrect because while some states use a single-factor sales formula, UDIP's original standard includes all three factors. Option C is incorrect because businesses must pay income tax in any state where they have nexus, not just their headquarters state. Option D is incorrect because state taxation of businesses is limited by constitutional nexus requirements and federal law (GPL 86272). Question 23. When implementing new protocols in a shared environment, a large partnership is considering the tax implications of changes to its capital accounts and distributions. Under Subchapter K, how does the IRS generally treat partnership distributions? A. Partnership distributions are always taxable to the partners. B. Distributions reduce a partner's basis but are generally not taxable unless they exceed basis. C. All cash distributions are subject to ordinary income tax rates. D. Partners recognize gain on all property distributions at the time of receipt. Answer: B. Distributions reduce a partner's basis but are generally not taxable unless they exceed basis. Explanation: partnership distributions generally reduce partners' outside basis and are not taxable unless the distribution exceeds the partner's adjusted basis. Option is incorrect because many distributions are tax-free. Option C is incorrect because cash distributions are not always taxable as ordinary income. They may reduce basis first. Option D is incorrect because property distributions are typically not taxable to the partner except in certain cases like marketable securities or disproportionate distributions. Question 24. During a major transformation where existing methods no longer align with regulatory requirements, a corporation decides to transition from a C corporation to an S corporation. What is one major tax implication of making an S election? A. The corporation must pay a built-in gains tax on appreciated assets if sold within 5 years. B. The corporation must immediately recognize all accumulated earnings as taxable income. C. All shareholders are required to report capital gains on the date of election. D. The corporation can deduct previously disallowed losses in the year of election. Answer A. The corporation must pay a built-in gains tax on appreciated assets if sold within 5 years. Explanation. When a C corporation elects S status, any appreciated assets held at the time of election may be subject to built-in gains, big tax if sold within 5 years of conversion. Option B is incorrect because accumulated earnings are not immediately taxable but may be subject to excess passive income tax. Option C is incorrect because shareholders do not recognize capital gains on election unless distributions occur. Option D is incorrect because previously disallowed losses may still be subject to passive activity limitations. Question 25. While updating traditional approaches where interconnections between tax and accounting rules create complexities, a business must determine how to apply the matching principle for tax purposes. How does the IRS's economic performance rule under IRSSS affect expense deductions? A. Expenses are deductible when the liability is fixed and economic performance has occurred. B. Expenses can be deducted as soon as they are budgeted for in financial statements. C. Businesses can choose to deduct expenses whenever they prefer. D. Taxpayers must wait until expenses are paid in cash to claim deductions. Answer A. Expenses are deductible when the liability is fixed and economic performance has occurred. Explanation. Under IRSSS, businesses can deduct expenses when the liability is fixed, the amount is determinable, and economic performance has occurred. G. Services provided, property delivered. Option B is incorrect because GOP financial reporting rules do not determine tax deductions. Option C is incorrect because deductions must follow IRS timing rules. Option D is incorrect because accrual method taxpayers do not need to wait for cash payments if economic performance has occurred. Question 26. In a situation where resource allocation becomes a challenge due to tax considerations, a company must decide whether to capitalize or expense certain costs. Under IRSSSA, which costs must be capitalized? A. Only direct labor and materials. B. Only interest on business loans. C. All direct and indirect costs related to inventory production. D. All business expenses, regardless of their nature. Answer C. All direct and indirect costs related to inventory production. Explanation. The IRSSSA UNICAP rules requires businesses to capitalize both direct and certain indirect costs related to inventory production. Option is incorrect because indirect costs, e.g. rent, utilities, depreciation also need to be capitalized if they relate to production. Option B is incorrect because interest is capitalized only if it is associated with self-constructed assets, not general business loans. Option D is incorrect because non-inventory related business expenses, e.g. advertising, selling expenses, are deductible. Question 27. During the introduction of new methods where coordination across tax and financial reporting is required, a corporation is analyzing the treatment of goodwill in acquisitions. How is goodwill treated for tax purposes under IRSSS? A. Goodwill is immediately deductible as an ordinary business expense. B. Goodwill must be amortized over 15 years for tax purposes. C. Goodwill is never amortized and remains on the balance sheet indefinitely. D. Goodwill is only deductible if it loses value and is written off as an impairment. Answer B. Goodwill must be amortized over 15 years for tax purposes. Explanation. Under IRSSS, goodwill from business acquisitions must be amortized over 15 years on straight-line basis for tax purposes. Option is incorrect because goodwill cannot be deducted immediately. Option C is incorrect because while goodwill remains on the balance sheet indefinitely for GOP purposes, it must be amortized for tax purposes. Option D is incorrect because goodwill is amortized regardless of impairment under tax rules. Question 28. In an environment where different components must interact under varying tax treatments, a corporation seeks to optimize the use of net operating losses (NOLs). How did the Tax Cuts and Jobs Act (ECJA) change NOL rules? A. It eliminated the ability to carry forward NOLs. B. It placed an 80% limitation on NOL deductions. C. It allowed taxpayers to carry back NOLs for 5 years. D. It required businesses to deduct NOLs in the year incurred. Answer B. It placed an 80% limitation on NOL deductions. Explanation. The The TCJA 2017 limited null deductions to 80% of taxable income and eliminated carrybacks except for certain farming losses. Option A is incorrect because nulls can still be carried forward indefinitely. Option C is incorrect because the carryback period was eliminated except for some special cases. Option D is incorrect because businesses can carry forward nulls indefinitely instead of deducting them immediately. Question 29. In a regulatory environment where obligations must be met with precision, a company is evaluating its compliance with the limitations on business interest expense deductions under the Tax Cuts and Jobs Act (ECJ). How does SUS-SSJ restrict business interest deductions? A. It limits the deduction to 30% of adjusted taxable income (ATIR). B. It eliminates the deduction for all businesses. C. It allows unlimited deductions if the company has more than $25 million in gross receipts. D. It only applies to corporations, excluding partnerships and sole proprietorships. Answer A. Limits the deduction to 30% of adjusted taxable income (ATIR). Explanation. SUS-SSJ as modified by the TCJ limits business interest expense deductions to 30% of adjusted taxable income (ATIR) for most taxpayers. ATIR is calculated as taxable income before interest, taxes, depreciation and amortization (EBITDA) through 2021. After that, depreciation and amortization are included. Option B is incorrect because the deduction is limited, not eliminated. Option C is incorrect because small businesses with gross receipts under $29 million 2024 threshold, inflation adjusted, are exempt from the limitation, not large ones. Option D is incorrect because the limitation applies to all businesses, including corporations, partnerships, and sole proprietorships. Question 30. In a scenario where past approaches are no longer viable due to changing tax regulations, a multinational corporation must consider the impact of global intangible low-taxed income, GILTI, under U.S. tax law. What is the primary purpose of the GILTI provisions? A. To impose a minimum tax on foreign earnings of U.S. corporations. B. To allow U.S. businesses to exclude all foreign income from taxation. C. To encourage corporations to shift more profits to foreign subsidiaries. D. To eliminate the need for U.S. businesses to track foreign earnings. Answer A. To impose a minimum tax on foreign earnings of U.S. corporations. Explanation. GILTI was introduced under the TCJA 2017 to prevent U.S. multinational corporations from shifting profits to low-tax foreign jurisdictions. It effectively imposes a minimum tax on foreign income that exceeds a deemed return on tangible foreign assets. Option B is incorrect because GILTI requires U.S. taxation of foreign income rather than exempting it. Option C is incorrect because GILTI discourages profit shifting by ensuring foreign profits face a U.S. tax burden. Option D is incorrect because businesses must track foreign earnings to calculate GILTI inclusions and deductions.